The headlines? US tariffs shake global trade. Emerging markets at risk. Investors pulling back from Asia, Latin America, and beyond. Sounds grim, right? But here's the thing, if you're counting emerging markets out, you might just be missing one of the most important long-term investment stories unfolding right now. Today, we're breaking down 3 reasons why emerging markets may not just survive the chaos, but come out stronger. This is Breakthrough Bizz, let's get into it. Emerging markets are no strangers to volatility. From the 1997 Asian financial crisis to the 2008 crash, to COVID-era supply chain chaos, these economies have been through it. And over time, many of them have become shock absorbers, not shock victims. Countries like India, Vietnam, Mexico, and Indonesia have built up stronger central banks, bigger foreign currency reserves, lower levels of external debt. So while global markets may panic over US tariffs or shifting trade routes, a lot of EMS today are more resilient than people realize. Their economic toolkits have evolved, and so has their ability to ride out storms. Yes, the US is bringing manufacturing back home. Yes, Made in America is making a comeback. But here's the twist. That doesn't mean all factories are leaving emerging markets. In fact, many are shifting, not disappearing. Take Vietnam, for example. When companies pull production out of China to avoid tariffs, they often land in lower-cost hubs across Southeast Asia. That means more investment into NUM's regional supply chain expansion and a boom in infrastructure, jobs, and innovation. Mexico is seeing record FDI, foreign direct investment, thanks to nearshoring, where companies set up operations close to the US, but not in the US. So while trade routes are changing, emerging markets aren't being left behind. They're simply being remapped. One of the most powerful reasons to stay bullish on emerging markets. People. Developed countries are aging fast. The US, Europe, Japan all face shrinking workforces. But emerging markets? They're young, ambitious, and digitally connected. By 2030, India will have the world's largest working-age population. Africa will add nearly 1 billion people to its labor force. By 2050, Southeast Asia will host a booming middle class with massive spending power. These are not just workers. They're consumers, entrepreneurs, and creators. Emerging markets aren't just sources of labor anymore. They're becoming engines of demand. And as wages rise and technology spreads, we're watching entire economies leapfrog development stages. In other words, growth in EMS isn't just possible, it's inevitable. Okay, so what should investors be watching? First, look for EMS with strong fiscal policies and healthy reserves. These are your safest bets when volatility hits. Second, track tech adoption and digital infrastructure.
Countries leapfrogging into the fintech or e-commerce space are ahead of the curve. Third, watch for investment flows, especially FDI, into manufacturing and services. Where money moves, growth follows. Emerging market ETFs, sovereign debt, and multinationals with M exposure could all offer long-term upside if timed right. Sure, there are risks, political instability, currency swings, commodity dependency, but here's the deal. If you're investing for the future, you can't afford to ignore the places creating it. So, should you count emerging markets out? Not even close. While the headlines scream disruption, the fundamentals tell a different story. Stronger institutions, rising investment, younger populations, and markets that are just getting started. Tariffs and trade shifts? They're real, but they're also temporary. The emerging world isn't retreating, it's reshaping. And smart investors are already paying attention. This was Breakthrough Bizz, where we follow the trends before they hit the front page. Subscribe if you're thinking globally. Drop a comment. Which emerging market do you believe in for the next decade?